Let's now discuss how to calculate portfolio return and risk. The expected return of a portfolio is the weighted average of the expected returns of the individual securities in the portfolio. The formula is the expected return on a portfolio, RP, is the summation of WI into RI. Basically, WI is the weight of the IH security in the portfolio and RI is the expected return on the IH security. N is the number of different securities in the portfolio. Note that the sum of the weights sigma WI is equal to 1. Using this formula, RP is equal to sigma WI into RI, we can calculate the expected return of the portfolio XYZ. Portfolio XYZ has got three securities X, Y and Z. X is the first security, I is equal to 1. Y is the second security, I is equal to 2. And Z is the third security, I is equal to 3. The respective weights in the portfolio are 25%, 30% and 45%. And the expected returns are 10%, 15% and minus 3%. To calculate the expected return of portfolio XYZ, we multiply WI with RI, we multiply 25% with 10%, we get 2.5%. We multiply 30% with 15%, we get 4.5%. And we multiply 45% with minus 3%, we get minus 1.35%. When we total these 2.5%, 4.5% and 1.35%, we get the expected return of the portfolio XYZ as 5.65%. Note that the sum of the weights sigma WI is 100% or 1. Now let's discuss portfolio risk. Portfolio risk is measured by variance or standard deviation of the portfolio. However, it is not a weighted average of the risk of the individual portfolio securities. This is the difference between the calculation of portfolio risk and the portfolio return, which we just did. Portfolio return is the weighted average of the returns of the individual securities in the portfolio, but portfolio risk is not the weighted average of the risk of the individual portfolio securities. Let's take a two-asset case where the formula for the portfolio risk, sigma P, is the square root of the following term: W1 square into sigma 1 square plus W2 square into sigma 2 square plus 2 into W1 into W2 into sigma 1 into sigma 2 into rho 1 2. Here W1 and W2 are the portfolio weights of security 1 and security 2. Because this is a two-asset case, there will be only two securities in the portfolio. Sigma 1 and sigma 2 are the standard deviations of security 1 and security 2. And rho 1 2 is the correlation coefficient between security 1 and security 2. Using this formula, let's calculate the portfolio risk for a portfolio where we have two securities with equal weight, 50% each, but the standard deviations sigma 1 and sigma 2 are 10% and 25% respectively. To calculate the portfolio risk, we first square the weights W1 square and W2 square, and we square the standard deviations sigma 1 square and sigma 2 square. If we square 50%, we get 0.25. If we square sigma 1, we get 0.01. If we square weight 2, we get 0.25 again. And if we square the sigma 2, the standard deviation of the second security, we get 0.0625. Then we multiply W1 square and sigma 1 square, these two terms, and we get 0.025. Then we multiply W2 square and sigma 2 square, this term, we get 0.015625. Then we calculate this term, which is 2 into W1 into W2 into sigma 1 into sigma 2 into rho 1 2. Basically, we multiply all these and double that, we get 0.0125. Then when we add all these three terms, this term and this term, we get the term in the bracket, which is 0.030625. If we take a square root of this, we get the portfolio risk at 0.175. We take a square root of 0.030625, we get 0.175. Therefore, the portfolio risk for a portfolio where there are two equally weighted securities with standard deviations of 10% and 25%, and the correlation coefficient between the securities is +1. Basically, they are perfectly positively correlated securities. The portfolio risk comes to 17.15%. If we keep everything else the same, but we reduce the correlation between the securities to 0.5, that is 50% instead of 1.0, and we do the same calculations, we get a portfolio risk of 15.61, which is lower than 17.5%, which was the portfolio risk of a security, of the portfolio when the securities 1 and 2 were perfectly correlated at +1. If we reduce the correlation further and say that the securities are not correlated, the correlation coefficient is 0, then the portfolio risk falls further to 13.46%. If we say that the securities are inversely correlated and the inverse correlation coefficient is -0.5, the portfolio risk falls further to 10.9%. And finally, if we say that the securities in the portfolio are inversely correlated at -1, we get the portfolio risk of 7.5%. Therefore, the lower the correlation, the lower the portfolio risk. Therefore, the benefits of diversification, investing into both the securities instead of only one security, are the maximum if the securities are inversely correlated, and if the correlation coefficient is -1, they are perfectly negatively correlated, and the portfolio risk drops to the minimum level of 7.5%.